All right, so this is our final module, module 8. We're going to be looking at hedge funds, mostly in this one. Um, so we're going to, we talked about hedging a bit before, hedging meaning, to offset risk. These are hedge funds which can have a lot of different properties. So initially, hedge funds were created to help establish hedges for other investments. But then hedge funds sort of grew into this alternative investment strategies, right? So they tend to have a lot more in derivatives than other types of positions. And their fees tend to be structured a bit differently because it's all about the returns. So we're going to talk about two models in particular, this Traynor-Blight model and then the Black-Litterman model. Understand that hedge funds are just difficult to price anyway, just because they, well, let me just start getting into some of the differences and it'll probably make sense as we go through it. So this is a comparison between hedge funds and mutual funds. So as you can see, as far as transparency, obviously mutual funds have to be a lot more open. Anybody can buy it, right? Where hedge funds are made for wealthy investors, and so a lot less reporting is required. As far as investment strategies, mutual funds are very open. This is how we're going to invest. This is our plan. And they don't use a lot of things like derivatives and short sales and leverage to maximize returns, where hedge funds will make a lot of different types of investments, a lot of very complicated investments, and they'll often use a lot of other tactics. Hedge funds have lockup periods that are often several years, right? So I'll give them the money and I won't get it back for 4 or 5 years. And then as far as the compensation, if you notice there, they have a lot more, they get higher compensation, and a lot of it is really around that. You see often 20% of profits, it's really heavily focused on the incentive structure, because that's what we want the hedge fund to do, is go out and get a lot of money, right? That's your goal in doing that. So as far as some of the strategies, right, there's directional and non-directional strategies. Directional strategies are I'm an expert in this one particular field. I know they're going to do really well or do really poorly, and then base on that. And then non-directional strategies are not looking at, oh, it's a bear market, bull market, anything like that. It's more just looking for mispricing and stuff. And there's a whole range of styles that I'm going to show you. So here's the types of styles, not necessarily an all-inclusive list. I'm not going to read all of this to you. You can pause it, of course, and read over it. But really what it is, as you can see, there's just so many different ways to make money, right? And because of that, we just, break out the funds by the style. Like, what are they trying to do? How are they going to try to drive their income? As far as some strategies, statistical arbitrage is really just looking at, is there mispricing between long and short positions? Is there some sort of, very technical trading, so what this data mining piece is looking at, hey, every time there's a fall in this industry, 6 weeks later, you see a fall in this, downstream industry or something like that, or, and so finding those types of patterns in the data, right, would be another way of looking for hedge fund returns. Some are what we call rapid, high frequency strategies, high frequency trading, right? And so these can be things where they're really going out of their way. Like, front running is when you know a trade is coming, so you try to do it before those people do, so that you capture the gains and they do not. Those types of things. So these are, different high frequency trading strategies. There's not a lot of low frequency, because the whole purpose of doing this is to get the highest return. Here's some examples of some hedge fund styles. And some of the choices made around those. And then, of course, you know, with it, you have different measures for performance, right? So it used to be that hedge funds would outperform passive indices, right? It was easy enough for them to do that. It's a lot less so now, you know, and it's just really hard to evaluate how is the hedge fund performing because it's not in the active market the same way. As far as liquidity, remember hedge funds have those lockup periods, right? So they don't have to be worried about cash holdings, which, you know, helps them a lot more. And so you have to remember that you're basically going to be getting that liquidity premium return as well. And so there's a lot that we could be attributing as alpha that's not really, right? And that's a concern. Again, this is a hedge funds become very difficult to evaluate for these types of reasons. And again, there's just some more liquidity comments. Because again, if you have this lockup period, that's an issue, right? There's also survivorship bias that we've already talked about, right? And then what they've known as backfill bias. So basically, if I you know, buy and I hold this for about 5 years and then it goes away, nobody ever knew about it. But if it was successful, then I'll go and drop in all of the old data for it. So we'll have all these returns over time, you know, and that sort of thing. So both of these biases will make hedge funds look a lot better because you're only seeing the winners. You didn't see all the ones that bombed, right, on the way. So that's the issue with there. Right. And so another issue is the fact that hedge funds are changing their level of risk, right? And so because of that, our risk is not consistent. So you can't really calculate alpha because remember, alpha was based on some expected return in the market, right? And then we have an excess return above that. But since our risk profile is changing, it's hard to make that comparison. And then if you've heard about things like black swans, we refer to those as tail events, right? And so these are really rare events, but they're significant events. Nassim Taleb wrote a book about called Black Swans, you know, where he was talking about these types of events which occur, and it only works until it doesn't, right? And then it doesn't work anymore. And but they, again, it's another one of those biases where some take advantage and some are not able to. But we attribute that to the smart person and not luck, right? So, and then this is some conversation about fee structure. So go ahead and pause this and read over it as you need. And so these issues like the high watermark, this is like where it got to before, right? And in that case, you're more likely to shut down funds, right? Which again adds to those issues that we have with the sustainability, the survivorship bias, you know, giving this false sense of the sustainability of it, right? All right. So this right here, talking about the Treynor Black model. So it's Treynor Black, and then trying to get like what is the best way of calculating alpha, right? And that's really what this is all about. Is was but is this a good method, right? So that is one approach, right? The Traynor Black. Black Letterman is also a potential model to use, right? And we use the variance covariance matrix, right? To look at what we would expect, right? And then that's how we're going to look at how alpha is from that baseline based upon that variance covariance matrix we calculate. Right. So we'll look at the recent historical data to get that matrix, use that to come up with a forecast, try to integrate the private views, like, well, I just generally think it's going to go well or poorly, right? And then give a revised expectation and then see how that fits. Right. So it's not that you do one or the other as much as you can do both. But that it allows you to look at what that performance is like. So I'm going to show you a couple of slides comparing Black Litterman to Traynor Black. Just feel free to pause and read through these. Okay. This paper, Kane, Marcus, and Tripley, they were looking at what is the active management fee like with these hedge funds, right? And so they found that the three drivers for those, the coefficient of risk aversion, right? So how risk averse are the investors? What is this squared information ratio? So we talked about information before, but when we're trying to determine, if we're like in these dark waters or not, and then the precision of the analysts themselves, right? Because they're giving buy and sell recommendations. And so all of these will drive what the active management fees will look like, right? So we've gotten better at this type of evaluation, but it's still a challenge. The Black models that we were looking at, right now there's still a lot more theoretical, so we're still building on that. But those of you that want to become CFAs, this is part of the new area within the CFA. So modules 7 and 8 will be covered in exam 4. And so that should conclude the course.